and welcome to the Global View on this Wednesday. Let's take a look at what's going on with the Fed. Policymakers, they're agreeing at their last meeting to take a cautious approach to raising interest rates. They'll only need to move them higher if data showed insufficient progress in lowering inflation. That's as revealed by the minutes from the last meeting, saying participants noted that further tightening of monetary policy would be appropriate if incoming information indicated that progress towards the committee's inflation objective was insufficient. The committee left the key lending rate unchanged at the 5.25% to 5.5% range at the beginning of the month. The minutes noting that participants commented on the significant tightening in financial conditions in recent months, driven by higher longer-term yields. The latest data shows US home sales dropped more than 4% to the lowest level in more than 13 years in October, as the highest mortgage rates in 2 decades, and low stock drove buyers from the market. And US Treasury yields edged lower on the Fed minutes, and after a poorly received auction of 10-year inflation-protected notes, the 2-year falling to 4.88 and the 10-year note down to 4.41%. And the US dollar fell for a third straight session on expectations that monetary easing will begin early next year. The Aussie dollar trading at 65.5 US cents. Well, to the story of the day, Nvidia reporting third quarter numbers after the bell in the States. Shares reverse course in after hours trade, despite a top line beat in both revenue and profit. Revenue coming in at just over $18 billion for the 3 months to the end of October, shattering last quarter's record sales of more than $16 billion and coming in more than 200% above the same period last year. Profits also surging with $9.2 billion in net income. Driving the numbers, it's AI-heavy data center unit, which brought in $14.5 billion of revenue last quarter, a year-over-year increase of 279%. Some cautious, though, on the outlook, with the company saying it's monitoring the impact of the geopolitical conflict, particularly in Israel. It has nearly 3,500 employees there. And China, also, Nvidia saying it sees sales to Beijing will decline significantly in the fourth quarter.
From the godfather of AI, Jensen and Nvidia, I think this is bullish, not just for Nvidia, but for broader tech, as the Don Corleone of AI yet again comes through. From a law of large numbers, you'll start to see that growth measure start to ultimately moderate. But at least for right now, I mean, this is the biggest tech transformation in the last 30 years. And they're essentially the only game in town in terms of Nvidia. But more importantly, it also shows what's coming to the shores of tech, $1 trillion of tech spending over the next decade.
That's from Wedbush. You can catch that full interview from 9 a.m. Eastern here at ausbiz. Well, the brutal downturn seen last year was the worst year for stocks since 2008 and the worst on record for bonds. But this year, the outlook has changed with a substantial upswing as the US shows robust economic growth. Mike Dickson from Horizon Investment sees reason for optimism, as he says the catalysts are in place for substantial investor gains.
This quarter certainly off to a different start, right? I mean, we've got, even this month alone, I think the entire equity market is just up 7, 8, 9% alone. Even in the bond space, you've had a really strong month and off to a great quarter. But look, I mean, we did come off of a down August. We came off of a down September and a down October. So it's nice to see some of that seasonal strength. And, this time of year certainly does normally see this seasonal strength. And we've had, of course, a number of strong data points in the last couple of weeks. And I think that has really set us up nicely coming into the holiday season.
Just before we do take a look ahead, taking a look at how we have performed over the past couple of years, has that 60-40 portfolio worked?
No, look, it's completely failed us, right? I mean, one of the things, that we were looking at recently, if you just go back and look at from the end of 2020, so it literally 3 years ago, almost at this point, a global 60-40 still has you down a couple percent. So this is, a 3-year period where, the bread and butter 60-40 portfolio that's in a lot of people's portfolios there has just literally gone nowhere. And that's, been driven, of course, by a struggling equity market. But I would actually say in larger part due to the fixed income side of things, because, you look back at 2022, bonds are not supposed to be down 15+%. And they were. And unfortunately, they were at the exact same time that stocks were struggling. And that's exactly what's kind of led to this 3-year period of really going nowhere. And while bonds have fared a little better this year, it's still been a very volatile, choppy ride for those markets. And look, we still have not recovered highs in the equity markets either from the end of 21. So I think in general, a lot of investors are probably pretty frustrated by that, and a lot of advisors probably getting calls and questions from their clients because they just haven't really made any money in several years.
So, Mike, let's look ahead then. And what are you seeing at the moment, particularly, I guess, how the US economy is traveling, where the Fed goes to from here, and what the outlook is? Let's first start with equities.
Yeah, look, I think that the equity market is somewhat of a coiled spring. We've had that view here for several months. When you look at coming into this year, a recession was the base case in the U.S. and other international markets, and in particular here in the U.S. that couldn't be further from the case. We've had analyst estimates both on the economy side of things as well as with earnings kind of putting those recession forecasts into their estimates, and we've consistently seen earnings beats and economic surprises as a result. I mean, most importantly, I would say the last quarter GDP print here in the U.S. at nearly 5% is just extremely strong. Now, we're not tracking quite that high as we head into the fourth quarter estimates, but still really, really strong data point, and that's driven in large part by the consumer that, from a lot of the excess savings from COVID and otherwise have been able to weather some of this higher inflation. And then look, last week, just seeing that inflation print come back down for, right around the Fed's 2% target on an annualized basis is something we haven't seen for a very long time. And so it does appear that while it has been slow, inflation is definitely in a downtrend, and that's a very good outcome as we head into this holiday season and this seasonally strong period for equity markets.
So, Mike, how do you see earnings going forward then? And I guess you only have to look at the most recent result from Nvidia, once again beating market expectations, particularly with forecasts there. So what's that telling you?
Yeah, absolutely. I mean, that's been something that the market's been waiting very carefully to see because Nvidia is up over 240% this year. Certainly the leader in the clubhouse with the Magnificent Seven that we've all heard about driving returns here in the U.S. this year. And the big question is all of this already baked in? I mean, they're more or less forecasting quarter over quarter growth of almost 100% on the revenue side. And look, they apparently they can keep meeting this, and so that really bodes well for technology and growth stocks in general. I think the AI theme at large, which is definitely powering a lot of that revenue and earnings growth from firms like Nvidia that are making that hardware, that has a huge potential from a productivity standpoint to. In a lot of ways, our view is it could be like this generation's version of the internet or the computers, just very powerful technology. And the market is absolutely rewarding Nvidia for being, at the front of that, of that charge.
Mike, what's your outlook then for the bond investor, given the volatility we have seen there, and bearing in mind, I guess, what's ahead, certainly as far as interest rate policy and the Fed is concerned?
Yeah, the Fed is done. They're really done. That the market certainly expects that to be the case. I think Powell was a little hawkish during their most recent meeting, which I think in large part was what drove such a strong reaction from equity and bond markets with just a small beat on the inflation side last week. Like that wasn't a huge beat, but it was a little better than expectations. And because of how Powell had expectations set, the market rallied strongly to that. So, when you look at December, of course, we get another inflation print and we do get a Fed meeting. We don't expect any surprises there. The Fed has been right down the fairway, touting being data dependent. every single time. And if that's the case, the data is pretty clearly telling us that there's no reason to get carried away with the rate hikes. So that's when you look out at the futures curve as it relates to rates, and you got to go all the way out till even May or June to see any cuts being priced in. And really, we should begin to see interest rate volatility begin to come down. Interest rate volatility has been really elevated all year, and I think that's made it very difficult for markets to really have these strong surprises upward, because if you can't price a risk-free asset, how are you going to price a risky asset? So we've begun to see that volatility in interest rates drift lower, and I think with a lot of the recent data that we've seen, and hopefully no surprises in December, which is our base case expectation, you're going to continue to see interest rates come back down. But look, I'll also say, I don't expect, I'm talking about interest rate volatility coming down. I don't necessarily expect interest rates overall to come back down. I think we are in what we would consider actually a more normal range right now. What was abnormal was, the 2020 period and prior, and having interest rates just on the floor. That's not normal. But having the 10-year here in the 4 to 5% range is totally normal. The market does appear to be able to withstand the worst of it, and that's just getting to this point. And from here, we think that interest rates are probably going to be around these levels. And hopefully we begin to see that volatility in the interest rate market drip lower. And then that'll be a really strong catalyst for the rest of kind of the risk asset universe.
Mike, are you looking to diversify your portfolio at the moment? Would you be considering alternatives, for instance? And how important is it to have some sort of risk management at the moment?
Yeah, I mean, alternatives did really good for you last year in the commodity space, not so much this year. I think that at least in a lot of our kind of client base in more of the kind of retail community with financial advisors, we're not huge users of alternatives in that space. That would definitely be a little more for kind of the CTA hedge fund type community. But we do believe risk mitigation, can come from much more, reliable and consistent sources. For example, derivative-based strategies offer a great way to reduce equity risk without the exposure to interest rates that has failed us over the last couple of years. And so, you see, in some of our products and many of the other, newer products in the U.S. markets, derivative-based strategies are becoming quite popular for those purposes.
That is the outlook from Mike Dickson from Horizon Investments. Just a quick check of the market when we get going in less than a minute's time now, and we are expecting a relatively flat open, marginally lower as you can see. Stay with us, the open is next.